What if I told you that while the entire world is obsessing over gold, a different metal just quietly crossed a threshold that hasn't been seen in over a decade, and the smart money is already positioning themselves before the general public even realizes what's happening? In the last 90 days, something shifted in the global commodities market that has analysts from Goldman Sachs to independent researchers scrambling to revise their forecasts. If you're still thinking this is just another clickbait story about silver, you're about to discover you've been looking at the wrong part of the periodic table entirely. Before we go any further, if you're someone who wants to understand where real wealth is moving before the headlines catch up, you're in the right place. Here on the Wealth Continuum, we break down the financial shifts that actually matter to your portfolio and your future, not just the noise that fills your feed. Go ahead and subscribe right now, because what we're covering today isn't something you'll hear on mainstream financial news until it is already too late to position yourself advantageously. Also, drop a comment and let me know where you're watching this from, because I'm curious to see how global this audience really is and whether you're already seeing these changes in your local markets. Now, let's get into this. When you think about safe haven assets, your mind probably goes straight to gold. That's been the default setting for investors for literally thousands of years. Gold is wealth, gold is security, gold is the thing you buy when you don't trust anything else. But here's what's interesting. While gold has been doing its thing, hovering around $2,000 an ounce and getting all the attention from both retail investors and central banks, another metal has been making moves that are far more dramatic when you actually look at the supply and demand fundamentals. And unlike gold, which is primarily a monetary metal and a store of value, this metal is caught in a perfect storm of increasing industrial demand, constrained supply, and a geopolitical landscape that is basically guaranteed to make it more valuable regardless of what happens with inflation or interest rates. I'm talking about copper. Before you click away thinking this is boring or too industrial or not sexy enough for your investment strategy, hear me out. Because what's happening with copper right now is arguably one of the most important commodity stories of this entire decade. And it has implications that stretch far beyond just the metal itself. This is about energy transition, about US-China competition, about supply chains, about inflation, and about how the next 10 years of economic growth or contraction will actually play out in the real world, not just on a Federal Reserve balance sheet. Let's start with the basics, but in a way that actually matters to you. Copper is essential for electrical wiring, for plumbing, for construction, for electronics, for basically anything that conducts electricity or needs to move energy efficiently. You already knew that. But what you might not know is that the green energy transition that every major economy is committed to, whether you personally believe in climate change or not, is incredibly copper intensive. An electric vehicle uses about 4 times as much copper as a traditional internal combustion engine vehicle. A single wind turbine requires somewhere between 4 and 15 tons of copper, depending on its size. Solar installations, grid infrastructure, battery storage systems, all of them are copper hungry in ways that our current economy simply is not. Now, here's where it gets interesting. Global copper demand is projected to nearly double by 2035, according to forecasts from S&P Global. We're talking about going from roughly 25 million metric tons annually to somewhere north of 45 to 50 million metric tons. Now, that's not a small increase. That's not something you can just mine your way out of easily. And here's the kicker. We're not discovering new copper deposits at anywhere near the rate we need to meet that demand. The last major copper discovery that actually turned into a producing mine happened over 2 decades ago. It takes 15 to 20 years on average to go from discovering a copper deposit to actually extracting ore from it at scale. And that timeline has been getting longer, not shorter, because of permitting issues, environmental regulations, political instability in mining regions, and the simple fact that the easy-to-reach copper has already been mined. So you've got demand that's set to explode and supply that's extremely inelastic. In economics, that's called a setup for a price surge. But it's not just about the long-term fundamentals. Something is happening right now that's making analysts revise their near-term outlooks. In late 2024 and early 2025, copper prices started behaving in ways that suggest the market is already pricing in scarcity. We saw copper futures spike above $4.70 per pound at various points, levels that haven't been consistently maintained outside of brief speculative runs. And unlike previous price spikes that were driven purely by Chinese construction demand or short-term supply disruptions, this time the buying is coming from a different place. It's coming from strategic positioning. Let me explain what I mean by that. Countries are starting to treat copper the way they've historically treated oil or rare earth elements, as a strategic resource that you need to secure access to regardless of price. China has been stockpiling copper for years. They're not just buying it for immediate use. They're building reserves because they understand that if you control the supply chain for the inputs of the next industrial era, you control the era itself. The United States, which has been asleep at the wheel on this for decades, is finally starting to wake up. There are now serious discussions in Washington about copper being a critical mineral for national security, about onshoring refining capacity, about securing supply agreements with allied nations. When governments start talking like that, it means the era of treating something as just another commodity is over. And here's something that should genuinely concern you if you care about inflation. Copper is what economists call a leading indicator for economic activity. It's used in so many different industries that when copper prices rise, it usually means either economic growth is accelerating or input costs across the entire economy are about to go up. Right now, we're seeing copper prices stay elevated even as other industrial metals have cooled off, and even as economic data has been mixed at best. That's unusual. That suggests the price is being driven by something other than normal business cycle demand. It's being driven by structural shifts that aren't going away. Now let's talk about the supply side, because this is where things get really interesting and frankly a little bit scary if you're thinking about what this means for the average American consumer. About half of the world's copper supply comes from just 3 countries: Chile, Peru, and the Democratic Republic of Congo. Chile and Peru have both experienced significant political instability in recent years. Mining operations have been disrupted by protests, by strikes, by governments that are increasingly hostile to foreign mining companies and increasingly interested in capturing more of the economic rent from their natural resources. The DRC is a geopolitical nightmare with Chinese companies controlling most of the extraction and refining operations. If you're the United States and you're trying to build out a domestic electric vehicle industry, a domestic renewable energy infrastructure, a domestic semiconductor manufacturing base, all of which require enormous amounts of copper, and you look at that supply chain, you should be terrified. Because you don't control any of it. This is why some analysts are starting to call copper the new oil. Not because it's an energy source, but because it has the same characteristics that made oil geopolitically critical for the last 70 years. It's concentrated in a few regions. It's controlled by a few players. It's absolutely essential for modern economic activity. And there's no easy substitute for it. You can't just switch to aluminum in most applications. You can't just use less of it without fundamentally changing how you build things. You're stuck with it. And when you're stuck with something and the supply is tight, prices go up a lot. So where does this leave us as investors, as people trying to preserve wealth, as Americans watching our economy navigate this transition? Well, there are a few ways to think about this. The most obvious is direct exposure to copper itself, either through futures, through ETFs that track copper prices, or through equity in copper mining companies. But here's the thing about mining equities. They're incredibly volatile, and they're subject to all kinds of operational risks that have nothing to do with the underlying metal price. A mine can flood, a government can nationalize it, labor can strike, permitting can get held up. You could be right about copper and still lose money on a mining stock. The more interesting angle, and the one that I think fewer people are paying attention to, is what happens to adjacent sectors when copper becomes genuinely scarce and expensive. If copper prices double from here, and that's not an outlandish scenario given the supply-demand fundamentals, what happens to the cost of building new homes? What happens to the cost of electric vehicles? What happens to the cost of building out renewable energy infrastructure? All of those things become more expensive. That has ripple effects through the entire economy. It affects inflation. It affects consumer purchasing power. It affects which companies can actually execute on their business plans and which ones get squeezed by input costs they can't pass on to consumers. And here's the part that ties this all back to the broader macroeconomic picture that we talk about so often on this channel. The Federal Reserve has been trying to manage inflation while also not crashing the economy. They've been raising rates, then pausing, then talking about cuts, then walking that back. It's been a delicate balancing act. But what happens when you have structural inflation coming from commodity scarcity that has nothing to do with monetary policy? You can't interest rate your way out of a supply shock. If there's not enough copper to meet demand, raising rates doesn't create more copper. It just makes it more expensive to finance the projects that need copper, which can actually make the shortage worse by delaying supply expansion. This is the kind of inflation that central banks genuinely struggle with because their tools don't address the root cause. Now, I want to zoom out even further, because I think there's a bigger picture here that connects to themes we've been tracking for months. We're living through a period of deglobalization, whether it's driven by geopolitics, by pandemic supply chain failures, by rising nationalism, or by all of the above. The era of frictionless global trade and just-in-time supply chains is over. Countries want resilience, they want control, they want strategic autonomy. And that means they want to secure access to critical resources. Copper is one of those resources. But so is lithium, so is nickel, so is cobalt, so are rare earth elements. The entire suite of materials that you need for batteries, for electric motors, for high-tech manufacturing. What we're watching in real time is the commoditization and weaponization of the energy transition. Whoever controls these supply chains controls the future. And right now, China controls most of them. They control refining. They control processing. They've been buying up mines and signing supply agreements for the last 20 years while the West was busy financializing everything and offshoring production. Now we're trying to reverse that. But you can't reverse 20 years of strategic positioning overnight. It takes time. It takes capital. And it takes prices high enough to justify building all that infrastructure domestically, even though it's more expensive than just buying from China. This is why copper prices staying elevated isn't just a commodity story. It's a signal that the entire global economic order is being restructured in real time. And for investors, for people trying to figure out where to put their money in an environment like this, you have to think beyond just stocks and bonds. You have to think about real assets, about things that have tangible value in a world where supply chains are uncertain and where geopolitical competition is intensifying. Copper is one of those things. It's not as emotionally satisfying as gold. It doesn't have thousands of years of history as money. But in terms of what is actually going to drive economic and military power over the next 2 decades, it might be more important. So here's what I want you to think about. We've been conditioned to view commodities as cyclical, as things that go up and down based on economic growth and recession. And for a long time, that model worked. But what we're entering now is different. We're entering an era where certain commodities are going to be structurally undersupplied for years, maybe decades, because the investments needed to expand supply were not made when they should have been, and because geopolitics is now interfering with the efficient allocation of resources. Copper is the canary in the coal mine for this new reality. If you're paying attention to copper, you're paying attention to the leading edge of a much larger shift in how the global economy is going to function going forward. And look, I'm not sitting here telling you to go all in on copper futures or to dump your entire portfolio into mining stocks. That's not the point. The point is to recognize that the rules are changing. The assets that protected wealth in the last 40 years might not be the assets that protect wealth in the next 40. The strategies that worked when globalization was expanding and supply chains were efficient might not work when the world is fragmenting and resources are being hoarded. You need to adapt. You need to think critically about what actually holds value when the system is under stress. So here's my question for you, and I really want you to answer this in the comments because I'm genuinely curious where people's heads are at. Do you think copper is genuinely going to become the new strategic metal that reshapes global power dynamics? Or is this just another commodity cycle that will eventually normalize? Are you positioning yourself for a world where resource scarcity drives investment decisions? Or are you sticking with traditional assets and hoping central banks can manage their way through this? Let me know what you're thinking, because the conversation around this is just as important as the information itself. The reality is, we're living through a transition that most people won't fully understand until it's already happened. By the time copper scarcity is a mainstream news story, by the time your neighbors are talking about it, the big moves will already have been made. The wealth will already have shifted. That's how it always works. The people who see the pattern early, who understand the fundamentals before the crowd does, those are the people who position themselves advantageously. Everyone else is just reacting. And in markets and economics and wealth building, reacting is how you lose. So stay sharp. Keep asking questions. Keep looking at the data that doesn't make the headlines. And remember, the biggest opportunities are usually hiding in plain sight, disguised as boring industrial metals that nobody wants to talk about at dinner parties. Until suddenly, everyone does.